This is a stock analysis blitz for Bank of Cyprus Holdings. Bank of Cyprus operate in Cyprus. They're listed on the Cyprus Stock Exchange as well as on the London Stock Exchange. Now, Cyprus is actually one of the EU's best performing economies. It's actually a fairly dynamic economy, could potentially turn into a bit of a Jersey, and the macro indicators for Cyprus are outperforming the rest of the EU. And so this puts the Bank of Cyprus into a very good position. Plus, as a EU state, this affords the Bank of Cyprus the status of being a systemically important, too big to fail bank. They've got a policy of paying out 30 to 50% to shareholders, and we're currently at the lower end of this at 30%, which corresponds to a 8% dividend yield plus buybacks. We can see that because of the high interest rates at the moment, their income from net interest has increased substantially at 72%. However, they get 16% of their income from fees. Although it's not a big percentage of the overall proportion, they also have other revenue streams as well. Now, when you look at their net income history, the performance around 2018 to 2020 looks a little bit uneasy, but this was actually because the company went through a lot of changes at this time. They sacked, it seems, thousands of employees and closed a third of their branches in what they called the beautifully named voluntary staff exit plan. And they also did this thing called Project Helix, where they wrote off some of their non-performing assets, packaged them and then sold them onto other companies who took on all the bad loans, most of which was attached to mortgages. So, of course, selling off all of these bad assets and also sacking loads of staff and closing branches, it costs money to do that. And when you take into account of that, without those costs, these blue bars here are my estimation of what their net income would have been without going through that process of Project Helix and the VEP. So you can see actually that accounting for that, they had a fairly robust performance, even though it was disguised by the Project Helix and VEP exercises. And the benefit of these exercises, according to my amateur calculations, result in a 100 million uplift moving forward. So this explains how in 2023 they had such an amazing result. They had the benefit of the higher interest rates, plus a 100 million uplift from the voluntary exit plan and Project Helix, explaining this sharp increase in their net income. In terms of their capital ratios, they are in a fairly solid position. When I compare them to the other stocks in my shortlist, they've actually got the best capital ratio situation of all the banks I've filtered here. So here I've got the operating profit by business unit. And first we can see that under this higher interest rate environment, all of the business units do better. The only exception perhaps being the insurance, which is a bit more steady. And this gives a good example of the different business units, the different things that the bank are doing to make money. We have payment services, actually are the number one for card processing and digital payments within Cyprus. So it's good that they have this aspect to the business because I think this is the future. The treasury is where they manage the liquidity of the company, which they have to do, obviously. For example, how much cash do they have at the central bank? But that does obviously yield interest income. Then they have their insurance business and wealth management. And both of these are obviously where they have a large base of existing customers. They can sell them these products on top of their normal banking. But actually, the majority of their income is from their retail banking, and they have a 38% market share of people in Cyprus using the Bank of Cyprus as their checking account. And then the commercial banking is really the second biggest component of their operating profit. But only a small sliver of those profits come from these small businesses, with more of it coming from corporate banking. They also have a significant investment banking. And then finally, this Remu business segment, this is actually where they have lots of legacy property, mainly from repossessed houses, and they've got a special business unit that's just for the selling of those. But this business unit is actually normally loss-making, but it's something which is declining as a business unit every year as they eventually get rid of all the properties left over from the past. So here I've got their assets and the liabilities, and this is a good way of understanding how a bank works. On the liabilities side, we see that they have 19 billion of customer deposits. Now here I've got a breakdown of those customer deposits, and we see it's mostly in Cyprus, and roughly half of it is actually people who've got savings there, or deposits where they have to give notice before withdrawing. So that's kind of good. But 53% of it is demand deposits. A lot of their deposits are retail, but then some is commercial banking and some investment banking. So a lot of these deposits are where people are actually depositing at the bank because they need to have money there. I mean, thinking of it from a retail aspect, you've got like a captive audience. 38% of all people living in Cyprus, they're having to use Bank of Cyprus as their bank, or there might be one of two other banks as an option. And you're kind of like a captive audience. Every human needs a bank to exist, really. So you've got to have your money deposited somewhere. And a lot of it might just be just to pay the bills and things. But what happens is the bank ends up with all this money churning around, which are customer deposits. And whereas you as a customer are only getting practically zero interest rate for that, because the bank knows that not everyone's going to withdraw that money at once, they can then take that money and invest it into things that offer higher interest rates. And so this is the basis of usury, and this is how banks make their money. Majority of their liabilities are actually customer deposits. And even though a lot of those must be individual customers with less than, say, 1,000 in there, because on aggregate, all that money is kind of staying there, because everyone has to use banks in order to live and pay their bills and stuff. The banks can take that money and then invest it and get a higher interest rate. And so this demonstrates really nicely how banks are making money from usury, and also how banks are doing better in a higher interest rate environment. So as well as customer deposits, there are these funky things up here, which are things like debt securities and things. That's where the bank issues bonds and various financial products, and they get cash in return for that. But they then have to pay out quite high interest rates. We see here they have senior notes which they have to pay 7.4% interest on. But these, obviously, a bank that's in trouble, like Credit Suisse perhaps the other year, would have a higher proportion of their liabilities being this funky stuff. But in the case of Bank of Cyprus, it's all relatively healthy stuff. And I think when we look at the breakdown, I do think that the quality of, even though I am a bit of an amateur here, to me the quality here just seemed okay. An interesting thing is this TLTRO down here. So this is actually funding from central banks, and what happened was when we had the Wuhan outbreak, part of the recovery package for that was the ECB actually printed a load of money which taxpayers pay for by inflation, and then deposited it at the bank, and it only paid zero interest. So we have this incredible situation where the banks, including the Bank of Cyprus here, got a load of extra deposits which they don't have to pay any interest rates on. but they can actually deposit that at the bank and they're now getting a 4.5% interest for that, and all on the back of the taxpayer. An incredible reality that I noticed there. The TLTRO though is actually going to end by next year, so that is perhaps one risk factor for Bank of Cyprus, which is, and in fact all banks, which is they're going to have to replace this free money from the central banks, presumably with some funky stuff. But in the case of the Bank of Cyprus, it's only a minor proportion of the overall deposits. So then over on the assets side, and we see a very healthy percentage of their assets, that over about a billion, is just deposited at the central bank. So I take that to be the Central Bank of Cyprus, and they're getting the base rate, and then a large proportion is of those assets are packaged as loans to customers. We've got a breakdown here of that actually, and about a third of it is commercial real estate, a third of it is mortgages, and a third of it is loans to small businesses. So here we see how the bank works. So they get a higher interest from those loans, which are assets, than they have to pay out to the customer deposits. Now, I think the commercial real estate is like a risk factor for banks. I mean, there's a lot of talk about that. But when we look at the NPEs or the non-performing exposure numbers for these assets, actually they're really quite low, at only 3 to 5%. So I'm fairly happy with the quality of these assets. And it's interesting to compare with 2019, which is prior to the Project Helix. And then you see in how much trouble the bank was, and it really is quite impressive how they've improved the quality of their assets through that Project Helix. The final component is there are other assets which are the kind of funky stuff, things like buying collateralized commodities and things, and treasury bills and equity investments. So these obviously pay higher interest, but they're kind of higher risk. But actually, in the case of Bank of Cyprus, the majority of the assets seem to be the quality stuff. And it's going to be very interesting to compare the assets and liabilities of Bank of Cyprus with the likes of Lloyds and Barclays when I take a look at them in the next few weeks. So here's the share price of the Bank of Cyprus over the last 5 years. And in 2019, they had a new CEO who seems to have done a good job. So Project Helix had 3 stages to it. And overall, they managed to get rid of about 5 billion's worth of non-performing loans, which they sold to these various people better at them recovering the assets and repossessing the houses, etc. We also have in 2019, they begin their voluntary staff exit plan. And if I didn't read this wrong, initially they actually sacked 4,701 staff. And then when we get to 2022, it was like the final stage of it, where they closed 37, it's roughly 40% of their branches, and sacked 30% of their staff, which is 1,300 staff. And I'm fairly sure I got this right, that in 2019 they sacked about 4,700 staff. This is obviously, as a shareholder, a really good thing. It shows you that they really are serious restructuring the company so it can operate at a profit. In 2022, there was the excitement of the Irish company Lone Star trying to take them over, but Lone Star gave up after 3 takeover attempts. And then, so of course, following the success of the Project Helix and the voluntary staff exit plan, we saw the share price 3x. And in 2023, they announced they were going to start paying dividends again. And in 2024, they announced a rather large 7.2% dividend and 25 million share buyback. Now, I've decided to start investing in bank stocks, and if you want to see about that, take a look at the last video I did on YouTube. I've got a short list, but I've decided to go in a third now and the other 2/3 by the end of the year, when I'll be selecting another couple of banks. But I decided to go in with Bank of Cyprus first, which I did on Friday. And the main reason I picked them first is because the ex-dividend date for them, for this massive dividend they're paying, is actually the 25th of April. So I wanted to get in before then. Okay, so looking at their numbers, and what I've done is looked at the financial results around the time of the great financial crisis, the Lehman Brothers collapse in 2008, and then around the more recent times. And actually, they were making a profit even in the bad times around the financial crisis. And what seems to have happened is, although around the time of the great financial crisis, they did see a significant increase in the non-performing exposures. When we look at 2018, we then see the number of bad loans jump up loads. And I think that maybe Cyprus wasn't so badly affected in the great financial crisis, but it may be a kind of aftershock, the Cypriot financial crisis. In 2013, almost as a aftershock to 2008, we had the Cypriot financial crisis. And when I looked it up, actually, a real estate bubble as well in Cyprus. And apparently 48% of uninsured deposits at the Bank of Cyprus was seized by the government in order to solve this. A lot of them were dodgy Russian characters. So, I mean, perhaps in light of recent history, you could say it's kind of funny that happened to them. But really, a situation where the government just seizes people's money that's held at the bank is, it really should be a unacceptable situation. So, but all the same, there was this seismic event in 2013. And then this takes us to where I started looking at the numbers, and you can see they were loss making. But it turns out that a lot of these losses were because of costs associated with the Project Helix and also with the staff voluntary exit plan. So you got to realise that there was a seismic event in 2013, and from 2018 to 2020, there was all this clear up operation. And now, actually, the company now in 2022 and 2023 is the company that's kind of cleansed of all these bad assets that were removed. Help with the help of Project Helix, and by some rather extraordinary reductions in the number of bank branches and number of staff working at the bank. We can see how the net interest income has started shooting up as bank rates started shooting up the last couple of years, whilst the net fee and commission income is fairly steady. On the expenses side, I'm fairly disappointed that actually the staff costs haven't really gone down that much compared with 2018, despite sacking all those staff. And the same with the running costs. But really, the magic is in these line items here, which are all related to the Project Helix or the mass sackings of staff and closing the branches. And so these are the all these costs here are kind of like one-off costs, because now they've completed those processes. You can see those costs don't continue. And so by considering that, that's how I got to these blue bars, which show that when you account for that, actually the performance of the bank has been fairly robust. And I've calculated by looking at what marginal reductions there have been in running costs, and then also looking at the improvement here in the reduction of credit losses. As you can see, following Project Helix, credit losses have reduced quite a lot. That's how I arrived at my 100 million uplift every year as a result of those exercises. I've got here their income broken down into different types, and you can see that their income, you can see that the majority of their income always has been and looks like always will be from net interest income. So that does confirm my theory of higher interest rates being good for the banks. And here I've got their expenditure. And what we see is that most of their expenses really the most significant expenses are the staff costs and other operating expenses. And we see, especially when you account for inflation, these have been kept down versus the 2008 situation. And it's interesting how low the credit losses look now. And it's interesting to go back to 2008, 2009, where we see the banks getting into trouble there with their bad loans. What I noticed that was interesting is you can't actually use this data to predict the next financial crisis, because the actual credit losses weren't realized until after it was too late, after the financial crisis had happened. That's when you all of a sudden, 1-2 years later, see them appearing in the books. But overall, the income and expenditure situation here does look like the situation is a lot better now than it was back then, when banks used to be valued much, much more highly. Now, in terms of the assets and liabilities, I've covered that already with this slide. Rather than dig into every line item here, I've got here the assets and liabilities in this format. In terms of liabilities, the vast majority are customer deposits, and the TLTRO stuff, which I was a bit worried about what happens when that ends next year, is actually still quite a minor proportion. They look quite healthy at this level, with most of their liabilities are just customer deposits. So as long as we don't have a big economic collapse, and that's my bet I'm making here. And then on the assets side, it's looking quite healthy, because most of it's the loans to customers. I showed you the breakdown of that on this slide earlier. And then a lot of the other is actually cash that they've got stored at the central banks, which they get a nice return on at current high interest rates. The funky stuff here in purple is kind of minimal. That's higher yielding but higher risk. But overall, their asset quality here does appear to be good. And it's very interesting in how much better shape banks are now compared with back before the big financial crisis, because now they've got lots of cash held at the central banks, which they're forced to by law with the capital ratios. And it's generally appears to be a kind of healthy mix. Before the great financial crisis, you see there's a lot of loans to banks here. And this was, I believe, the credit default swaps and things like this, where banks were lending to each other in a dodgy way. We don't really see that anymore, whereas that was a large proportion back then. And also, there was no cash back then. A very tiny sliver of their cash was being held at the central banks. Instead, they were loaning out all the cash in a dodgy way. See how the balance sheets of banks look a lot more healthy now than they did back in 2008. So here's the net income history. You can see how now there's a very nice trend of increased net income. And you can see how that whilst the costs are being kept down, the money that's pouring in is going up. And banks are obviously just a completely different animal, and quite abstract things to kind of value versus normal companies. And let me just remind you, this is the sector chart for banks in the UK. And back in 2007, banks were valued up here. Now they're valued down here. So even in those heady days, the actual market caps of the bank was a small fraction of the amount of money they were loaning out. even though the assets and the liabilities picture for banks looks very healthy now compared with what it was in 2008. The market cap of the banks is a fraction of what it was back then, even though they're in much better shape and making just as much money. So that is actually what's really attracted me to banks. I think they are not. I think that they've been long hated by the people who buy shares. That's just something I just can't resist taking a bet on. In terms of this profile, it's like I say, it's totally unlike the usual profiles for companies. What I've done here is I've integrated the loan book, which currently stands at 10 billion, the non-performing exposures, which are currently at only 4% of that value at 0.4 billion. Historically, in a historical context, they're looking in great shape here. As we move out of the recession, I'm not sure there's been a recession in Cyprus, but there has in the rest of Europe. But as the rest of Europe goes out of that, which is which is again something I'm betting on here. It's not certain by any means, but if my bet's correct and we start going into an economic recovery, you should then see the loans going up. We should then see the loan book going up. The NPEs here are at a very nice and low value, even in the middle of a recession in Europe. We see that the market cap measured against net assets gives us a price to book of only 0.6, so that would indicate undervaluation, and the price to earnings seems low at 3. So that completes my stock analysis blitz for Bank of Cyprus holdings. You've got to remember that this is a bet on the recession in Europe generally ending and going to a period of GDP growth. And this is also a bet on interest rates not going down much. So I think that banks are undervalued now compared with the last time when there was high interest rates. The quality of their assets and their liabilities seems to be fairly good to my amateur eye, and so that's why I've invested in the Bank of Cyprus. Please remember, I do these videos just for fun as a hobby, and always speak to a qualified financial advisor before making any investment decision. I'll see you at the next video. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.